Hey everyone, thanks for joining us today. I'm here with Barry Brooksby, our IBC guru, and we debunk a lot of myths on our channel about high cash value, whole life, infinite banking, and one of the biggest myths that I know was something I was completely confused about years ago when I started my own policy and strategy was just that I thought fixed premium, I'm putting X number of dollars in, it's locked in. I didn't realize how flexible these policies and this strategy actually is. So we really want to attack this myth today. Barry, what do we know about these policies and the flexibility that's there?
And Steve, you weren't alone. A lot of people believe that if they get a whole life policy, they've got to pay that same premium until the day they die. Not in the type of policies that we design. We're always looking at someone's goals specifically. But I tell clients often remember the word flexibility because the policies do have a flexible premium. Just this morning, I was on with a husband and wife where we were looking at their policy. They can fund up to $54,800 a year or as low as about $3,000 a year. That's a huge range of
Wow.
flexibility. So we want people to understand that one, you're not locking in to pay premiums for the rest of your life. You can go lower if you need to. We want to obviously set premiums up that best meet your goals. But there is that huge myth out there that these financial entertainers are spouting, that Wall Street financial advisors are saying, don't ever get a whole life policy because you are locked into this premium. It just isn't true. And we actually show it over and over again in many of the videos and podcasts that we do.
Okay, so for people that have been researching this, getting into it for the first time, how do you explain it? How does it work, Barry? What are the mechanics? So let's say I want to do a policy. I'm going to have a base premium. I want to put X number of dollars into my policy, like the folks that you just mentioned. How does it work? Why is there flexibility?
If you want a high cash value whole life policy structured for the infinite banking concept, you want to be able to take loans to invest in real estate, your business, crypto, right? Anything you want to invest in, there are three main components of that properly structured policy. Number one is the base premium. The base premium is what's funding the whole life insurance portion. Some of the base premium does go to cash value. The second component is a term insurance rider. You might say, well, this is whole life insurance. Why are you telling me about term insurance? We add a term insurance rider to raise the MEC limit so that you can get a lot of cash into the policy. The term rider needs to be on there for at least 7 years. Some people want it on longer. The third component, Steve, is PUA, paid up additions. And this is where you get most of the flexibility, that the PUA does not have to be funded to its maximum every year. You can change the amount of PUA that you put into a policy. Those three components make up a properly structured policy.
Okay, so what I hear you saying, just want to interpret it for people trying to figure this out. The base is pretty fixed. That's the cost of the actual whole life insurance. Then you got PUA, you got some term blended in. So the flexibility is in the PUA because if somebody wanted to back off of that, they could decide to pay less of their PUA at a particular time. Is that a fair
That's
statement?
right. As soon as the second year, or if they're paying monthly, as soon as the second month. So the PUA can be adjusted monthly, annually. There's not a set time frame that you're forced or required to pay PUA. There are some companies that say, hey, if you stop funding your PUA for 5 years or longer, it might limit you for future PUA contributions. And we look at that with every client. But the PUA is flexible so that people listening will know I am not locking into this premium for the rest of my life. Now, what about the flip side? What about this client this morning that says, hey, I know I can put $54,800 a year into my policy, but I want to put $75,000 or $100,000 a year into the policy. There is not flexibility upward. In other words, when you hit that MEC limit, what you need to do is start another policy so that you don't put more money into an existing policy above the MEC limit. We don't want to lose the tax-free benefits of the policy. I own multiple policies. A lot of my clients own multiple policies. But there are two other ways that we can have premium flexibility we'll get to in just a minute.
Super. So a lot of the buzz that people hear about having multiple policies, and maybe they default to thinking, oh, they're trying to sell me another policy. Not really the case. If someone hits that limit, the natural solution then is to say, hey, client, you're going to need to start another policy. And it's pretty common. I know you have more than one policy. I have more than one policy. I think everybody on our team has more than one. And it's for that reason, wanting to put extra cash in. So now I'm in suspense though. What are you going to reveal about additional flexibility? I might even learn something right now.
Yeah. Let's back up one step. Let's say you have a traditional whole life policy. It wasn't designed with a term rider. It wasn't designed with PUA. It was just designed for death benefit. And a lot of people have these types of policies because most life insurance advisors don't know how to properly structure a policy, or Steve, they don't want to because it dramatically reduces their commission. But if you have this old style whole life policy and you don't want to pay the premiums until you die, the two ways that you could stop, number one, is called a premium offset. The premium offset allows the dividend to pay for your policy premium. Now, depending on the year and depending on the amount of the dividend, some of that is up in the air. But the second way is what's called a reduced paid up policy. We call it RPU, the acronym reduced paid up in the industry. RPU means you're not funding a premium any longer. The dividend is not going to fund your premium. It's a fully paid up policy. You usually can do those anytime after the 7th year. However, in a traditional whole life, the time frame might be 20, 25, 30 years down the road, which still doesn't mean you have to fund a policy your whole life, right? So if you chose to do an RPU 30 years from now, you might lose a little bit of death benefit. But if you don't want to continue paying your whole life premium, there's two additional options. And both of those options, premium offset and reduced paid up, also work in a properly structured policy like I described, with the term rider, with the PUA. Matter of fact, they work even a little bit better because you've built up so much cash value growth. You generally are earning a higher volume of interest and a higher volume of dividends. A lot of people don't know this, Steve. Dividends are paid on total cash value. So the more cash value you have in a policy, the more volume of the dividend you're going to get.
So you have ultimate flexibility with those other two options, what you're saying, Barry, because if someone does get to a point where they've had their policy for a while, they just don't want to keep paying premiums, you can do that reduce paid up or premium offset strategy in addition to the flexibility and being able to back off on PUA and these kinds of other choices.
That's right. I have clients that come to me and they say, Barry, I only want to fund a policy for 10 years, 12 years, 15 years, whatever. And we'll show them their own illustrations where after that time frame, the premium column contribution, we show zero. But what's so fascinating, and I love to see it, I love to show it to clients, is even after the premiums stop, guess what? The cash value is still going up. The client's still earning guaranteed interest. You're still earning the dividend. So it doesn't mean that when you stop funding, you stop earning money. No, you keep earning money in the policy even after you stop funding.
Yeah, that cash is still working inside of the policy, and so therefore that will keep growing regardless if you back off the premiums. Okay,
Yeah,
yeah, go ahead.
I just want to be very clear. The word flexibility is a part of what we teach. We want clients to have that peace of mind. Think about what flexibility does to your peace of mind, right? Knowing that you don't have to pay premiums till you're 85 or 90 or till the day that you die. That can add a lot of pressure, especially after someone retires. They're not receiving that regular income through a job. So just remember the word flexibility. Listening, we can look at your own numbers together. Flexibility is a huge part of what we teach our clients.
Flexibility. So myth busted.